Hello again from me, Louis Rossouw. I'm a portfolio manager at Adviceworx Private Client Securities, and I'd like to spend the next 10 minutes or so sharing ideas with you. I will discuss the COVID-19 pandemic and its impact on the global economy and investment markets. I will also explain how Adviceworx interprets the current investment climate and share our view on prospects for the rest of the year. September's big financial news was the debt crisis at Evergrande, one of China's top three property developers. Its share price collapsed when it emerged that Evergrande was having difficulty in servicing its debt. The company's core business is residential property development, and it has 1,300 projects in 280 cities in China on its books. Like many Chinese companies, it borrowed heavily to finance its ambitious expansion, even as demand for residential property entered a period of sustained decline. If Evergrande were to collapse, it could potentially cause systemic risk similar to when Lehman Brothers collapsed in 2008. The Chinese government will probably bail Evergrande out, but then use the crisis as a pretext for reining in excessive borrowing and imposing stricter regulation in the property sector. By the end of September, nearly 235 million people had been infected with COVID-19 worldwide, and more than 4.8 million people had succumbed to the disease. The United States remains hardest hit, with 44 million infections and 717,000 fatalities. India, Brazil, the United Kingdom, and Russia currently make up the rest of the top five, and South Africa is still in 17th position in terms of the most recorded cases worldwide. By the end of September, more than 3.5 billion people, or 45% of the world's population, had received at least one dose of COVID-19 vaccine. 6.3 billion doses of vaccine had been administered, and the daily vaccination rate currently stands at 28 million worldwide. China had administered over 2.2 billion shots, followed by India with 880 million and the United States with 392 million. Based on assumptions about China, which does not provide this data, 2.65 billion people, or 34% of the world's population, is now fully vaccinated. An estimated 1.1 billion of them are Chinese, 237 million Indians, and 185 million Americans. The two biggest challenges remain vaccine shortages in the global south and vaccine hesitancy in the global north. Economic expansion continues apace in developed markets, but rising input prices and stubborn supply chain bottlenecks are slowing down the rate of recovery. Central banks have taken divergent stances towards the issues of inflation and interest rates, with the US Fed announcing that it's going to slow down the rate at which it buys up bonds, but that interest rate hikes are unlikely for the near future. The European Central Bank remains pro-stimulus, but the Bank of England has taken a more hawkish stance and signaled that rate hikes are possible in the medium term. It seems unlikely that the Evergrande crisis is going to lead to contagion, and President Biden's ambitious infrastructure bill is still stuck in Congress. This graph shows why the Evergrande crisis has caused so much concern. China is the world's second biggest economy, and residential property represents nearly 30% of its GDP and 35% of local government revenue. In developed markets, these figures are typically between 15 and 20% and around 18% respectively. Much of China's property development was funded with debt, and developers are battling to stay afloat as China's population stagnates and bond yields rise. Fortunately for China, the government and central bank have deep pockets which will allow them to throw the property sector a lifeline. Most global equity markets suffered a dismal September, with big technology stocks in particular pulling back sharply. It seems as if China has thus far been able to contain the fallout from the Evergrande crisis, and the US bond market is showing signs of weakness, with Treasury yields rising from below 1.3% to above 1.5%. Higher US bond yields have caused the US dollar to strengthen, and this has resulted in generally weaker commodity markets, with a few exceptions. The oil price is around $80 a barrel, and China has banned all cryptocurrency-related transactions. Most major global equity indices endured a torrid month, with only the Nikkei A50 and Sensex returning a positive result for the month. The Chinese A50 is, however, still the worst performing major index for the year to date and over 1 year, with the Sensex being the best performer over the corresponding period. Over 3 years, the Nasdaq still reigns supreme, with the Hang Seng the laggard. The various Chinese stock exchanges started 2021 on a high note, but since March, they've underperformed the MSCI World Index dismally. The reason for this is threefold. Firstly, authorities have attempted to drain excess liquidity from the Chinese financial system, which has been bad for equity returns. Secondly, there's been a massive regulatory crackdown by the authorities on some of China's leading firms. And thirdly, economic performance has been sluggish in recent months. The stronger US dollar and weaker demand from China caused global commodity markets to endure a sluggish month. There were some exceptions, however, mostly in the field of energy. On the one hand, some of the best performing commodities were to be found in the so-called clean energy sector, where lithium and cobalt, which are used in electric vehicle batteries, did well, but at the same time, so-called dirty energy commodities like crude oil, coal, and uranium had respectable months as well. Iron ore was the month's worst performing commodity. For the year to date, iron ore is also the laggard, with lithium by far the best performing commodity. As we enter the final quarter of 2021, it remains to be seen whether the signs of a slowing economy, which is negative for equities, or the unattractive yields on bonds and cash, which are positive, will have the bigger impact. There are also concerns over the possibility of the US economy overheating, and equally that the Chinese economy will slump. The bond market seems to indicate that overheating is the more likely outcome, whereas equity and commodity prices are apparently pricing in the latter scenario. The Eurozone is currently the best positioned from an economic and investment perspective, and the commodities boom is clearly over for the time being. With the US dollar strengthening on the back of higher bond yields, emerging market currencies are suffering as capital flows to the United States, but at the same time, the stronger dollar is cushioning the impact of lower commodity prices. China also featured in big local news. On the 21st of September, President Xi Jinping announced that China would stop funding and building new coal-based projects overseas as part of its commitment to reducing greenhouse gas emissions. This announcement could spell doom for the controversial Musina-Makadu Special Economic Zone in Limpopo, which would have revolved around a Chinese-built 3,300 megawatt coal-fired power station. While the provincial government has expressed dismay at the news, environmental activists are jubilant, since such a big coal station would massively increase South Africa's CO2 emissions and threaten water security in an already water-scarce region. According to government's Coronavirus Command Council, South Africa has finally emerged from its third COVID-19 wave. During September, 125,000 people tested positive, compared to 330,000 in August, and 5,400 deaths were reported compared to the previous month's 10,250. This brought the total number of infections to date to 2.9 million and the total death toll to 87,626. Vaccinations are proceeding briskly and 4.5 million doses were administered during the month. 9 million South Africans are now fully vaccinated, and increased use of the Johnson & Johnson vaccine means that this number is set to rise rapidly. Against this generally positive backdrop, President Ramaphosa announced that the country would move to lockdown level 1 on the 1st of October. Consumer price inflation rose even further in August, largely due to stubbornly high food prices. Core inflation, however, fortunately remains muted. The Reserve Bank has revised its inflation forecast for the full year upwards to 4.4%, but the medium-term outlook remains benign. As expected, the Monetary Policy Committee kept the repo rate unchanged, but there are increasing signs that the next move in interest rates will be upwards. The SARB has also revised its GDP growth forecast for 2021 upwards, but the outlook for subsequent years is actually not as good. To the great consternation of environmentalists, the National Energy Regulator has granted the Car Powership Consortium a generating license. Food price inflation remains a headache in South Africa. While the headline consumer price inflation is currently 4.9%, the figure for food and non-alcoholic beverages is 7.4%. This is concerning as food represents a large portion of the household budgets of poor South Africans. Over the past 12 months, the sharpest price increases were those for meat, bread and cereals, and dairy products and eggs. Fortunately for vegetarians and vegans, fruit and vegetable prices rose only marginally. Much has been said about South Africa's minerals export boom over the past 12 months. It is sobering to note, however, that the growth in revenue was almost exclusively due to higher prices, since the volume of exports, the blue line, remains well below its pre-pandemic levels. This is because a lack of certainty about government's policies regarding mineral rights, expropriation and BEE has discouraged new investment in mines and processing plants. To add insult to injury, the poor management of our railways and harbours is limiting our ability to export all that we produce rapidly and efficiently. This infographic depicts two disturbing messages about socio-economic conditions in South Africa. Firstly, that poverty and inequality have both gotten a lot worse in recent years, and secondly, that the country's tax base, which consists of the middle, and upper classes, has shrunk alarmingly of late, probably due to immigration. Between 2017 and 2020, the number of adults living in households with a combined income of less than 3,500 Rand a month has nearly doubled. At the same time, the number of adults living in households with incomes above 22,000 Rand a month has pretty much halved. The JSE All-Share Index suffered its worst month since October last year, with the Resources Index down a whopping 9% and only financials up marginally. The drama around Tencent in China has hit Prosus a lot harder than Naspers. Bond yields weakened sharply, and the yield on the 10-year SA 2030 bond ended the month 5.2% weaker. Foreigners remain net sellers of South African securities, and both the JSE and the bond exchange have seen net outflows of nearly 100 billion Rand for the year to date. The Rand weakened against the US dollar, as did most other emerging market currencies, and ended the month 4.4% weaker. I'd like to conclude with a number of observations about the past quarter. On the JSE, locally focused companies have become the darlings of late and the resources sector the dogs. Rand hedge stocks should find support in the form of a weaker Rand over coming months, and the muted economic growth outlook will sadly limit the extent of upside on the JSE. Listed property stocks have admittedly bounced back sharply in recent months, but we remain skeptical about their high debt levels and long-term prospects for the property sector post-pandemic. The bond market finds itself at a crossroads, and it remains to be seen whether pessimism over emerging market bonds or the attractiveness of our high real yields will prevail. Money market yields are likely to rise in the coming months, and global equity remains our preferred asset class. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.